Paul, they're still growing. Fair enough. It's a very crowded business. Value investors don't get growth. Quite the opposite. We don't overpay for growth. Therefore, it probably sucks. Okay, guys, Roku stock. Now, Roku is an interesting company. It's one of the device businesses for streaming, etc. I like it. I don't use it at my home here, but our vacation rentals that we have through our company, luxuryei.com, we have a lot of Roku. Now, my first comment on Roku is Cathie Wood likes it. Therefore, it probably sucks. But let's take a further look. So this is Cathie Wood's main fund, and Roku is her number 3 holding, 7.82% of her holding. Okay, Tesla's 10%. Now, let's pull up Roku in our software. Let's see how stupid Cathie Wood really is. Okay, Cathie Wood, everybody said she was brilliant, even including Jim Cramer said she was the smartest thing since sliced bread right when Roku was at $470 a share. It is currently at $63 a share with a low just a few months ago of $38 a share. Okay, now let's look at the fundamentals of Roku. $8 billion market cap, enterprise value. So $8.4 billion market cap. This is if you buy all the shares outstanding. $8.2 billion in enterprise value. This is awesome. That means if you bought the entire company and paid off all the debt with their cash and put the cash in your pocket, they actually have more cash on hand than debt based on this. Now, net income. They lost $500 million in the last year. But disruption, guys. But good news, their 5-year average free cash flow is $5.7 million. I want to repeat, $5.7 million, not billion, million. This stock is down. This used to be like an $80 billion, not $80 billion, but call it $60 billion stock. And the average free cash flow in the last 5 years was $5 million. The average NBA player has made more in the last 5 years than Roku has. And the average NBA player is not worth $8.38 billion after falling 80%. But I won't get into that right now. Okay, profit margin, minus 16%. 5-year average is minus 3.6%. Return on invested capital, negative. Now somebody's gonna tell me, Paul, they're still growing. Fair enough. And their price to sales ratio doesn't look that bad. That's the great thing about price to sales ratio. When you don't have profit, you can compare their price to sales ratio to their gross margin. As an example, Microsoft's gross margin is 68% and their price to sales ratio is like 8 or 10 or something like that. Okay, so there's potential there. I can see potential there, but it's a very crowded business. Apple TV, Roku, all these other businesses out there for devices. I look at Amazon, I look at it going, it's a very crowded business. It's gotta be an obvious buy to me. Let's go see what the 8 pillars look like. Oh boy. We've got one check, revenue growth. We don't even have an earnings. Like this is negative. Look at their price to free cash flow, 1,463. It makes Tesla look like a value play right now. Now, guys, one thing I want to talk about with Roku, though, just because it loses money doesn't mean a business that loses money doesn't mean it has no value. And here's the example. You've heard me say, if you've watched this channel, every investment is the present value of all future cash flow. Spoiler alert. Every time I buy a piece of real estate, I have negative cash flow. Why? Because I'm putting money into the property to drive up revenue and profit. So when I do that, I'm okay with it saying I'm going to get my payout a couple years down the road. Let me show you an example. Let's say a company has $5 in loss, then $3, then even, and then 5, 15, 30. Guys, this is a great story. This is a great story. If you think you can buy a company that's just going to grow from here, even if they only grow at 4 or 5% a year after this, you only have to absorb $8 in losses to then get $50 in profit in the following 4 years. So that's what I want everybody to remember. Growth is an important part of valuation. Growth is it's what drives the revenue and profit. Growth is so important. So when I hear people say value investors don't get growth, quite the opposite. We don't overpay for growth. That's the difference. We believe that growth is the most important aspect to a business when determining a future value. And this is what I'm showing you here. Now, the problem with Roku is, this is what it is. There's no end in sight on these losses. And then maybe someday, if you believe analysts, they make a few bucks and it has to grow from there. So the end story has to be so good that you're gonna make your money. But the question becomes, is that reasonable? What things have to happen? What are the hurdles they have going forward? Could they overcome the hurdles? Absolutely. But I look at a company like Apple with Apple TV, and Apple's getting more and more ingrained in our lives. And I'm like, man, is that really gonna overcome Roku? Is Roku really gonna overcome Apple? I don't know. But to me, that might be enough of a question to sit there and say, that's scary for Roku. Because let's say Roku doesn't manage to let's say they just keep their market position the same. Have they proven they can make money? They haven't. They've barely proven they can make cash flow. These are the things you have to ask when you're looking at a company. What am I buying for the future? What does the future look like? And the less likely the less apparent the future is, the less obvious the future is, the more margin of safety you have to have. And that's all I'm explaining to people. Amazon had a very, very, very uncertain future back in 1997, right? But if you saw that story, but how many different companies were like Amazon back then and how many of them made it? You're only remembering from selection bias the Amazon story. There were hundreds and hundreds of other companies that went to zero. That's the issue. So if you invest in all of them blindly, you're probably gonna end up losing even when you have the Amazon that wins. And that's the scary part. And on top of that, you have to absorb Amazon going from $113 a share down to $6 a share during the tech bubble burst. How many people would have ridden this out, saying, I believe the Amazon story? That's the hard part. And Roku is down a lot. And I do give Cathie Wood credit for still buying more shares, but she has to. Her reputation depends on it. And money's coming in still. I don't know why, but money's coming in still. We did a video a few years ago, back at the peak of ARK, and we looked at their companies, and of the 20 top holdings, only 3 were profitable. Forget about reasonably profitable. Only 3 were profitable. And you might sit there and say, well, Paul, I am okay with losses, but not when you pay top dollar for those losses. Not when you buy a company that's losing money based on a valuation that be reserved for a company that makes billions of dollars a year. That's where the disconnect happens. She talks about disruption. Guys, the internet was the most disruptive thing we've probably ever had. And how many companies went under? 99% of those internet companies went under. Some absurd amount. I once did analysis. If you went and bought every tech stock that was huge back in the day, you only made 3.3% on your money from 2000 to now. And 80% of those gains were from Apple, Microsoft, and Amazon. And that was after watching Amazon go from 113 to 6, so you just stuck with it. After watching Microsoft go from 52 down to 11 and stuck with it. And Apple, which was basically a defunct company at that. I mean, they were just doing terrible. So I look at this saying, what way do you want to be? Do you want to understand how to buy a company and understand how to value a company? We're the channel for you. Our software helps you do that. Our community helps you do that. The stock analyzer tool was used 1.3 million times last year. So I encourage you, go to everythingmoney.com, $7 for 7 days. The price is going up soon to $40 a month. So sign up now. You'll be locked in your category price. We still have people in the software paying $10 a month. Even after increases, they've gone up to $10 a month. That's absurd, guys. This thing is a game changer. It gives you all the tools. So please do that and go learn how to value a company. Thank you for your time.